Hi everyone, welcome to today's webinar, Navigating the New Revenue Recognition Standards for Technology Companies, presented by Citrin Cooperman and Early Growth Financial Services. My name is Amanda Young, and I'll be your moderator today from the Early Growth team. I just have a couple quick notes before we get started. This webinar will last about an hour, and that includes time at the end for questions and discussion. We will also take questions throughout the webinar. So please feel free to type in your questions into the control panel and I'll jump in and ask them at when we have breaks in the presentation. The next thing to note is that this webinar will be recorded and it will be sent to all of the registrants with the slide deck within 48 hours. You can also find this recording and all of the recordings of our webinars on our YouTube channel, Early Growth. So now before I pass this off to our speaker, I'd like to tell you a bit about Early Growth. Here's just a quick description of what we do. We're an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from their day-to-day accounting to financial forecasts to taxes and valuations. So now without further ado, I'd like to introduce our panelist, Michael Rhodes from Citrin Cooperman, who will tell us a bit more about himself and kick off today's discussion.
Thanks, Amanda, and special thanks to Early Growth Financial Services for allowing me this opportunity to speak to all of you. Good afternoon, everyone. Welcome to our webinar on navigating the new revenue recognition standard for technology companies. My name is Mike Rhodes, and I am an audit partner at Citrin Cooperman, which is a US-based accounting and advisory firm headquartered in New York City. I am the technology practice leader for the firm, and I'm currently working with a number of our technology clients on the implementation of the new standards. As mentioned, today's program is focused on the new revenue recognition standards as they specifically relate to technology companies. In the US, ASC 606 is effective for fiscal years beginning after December 15, 2017 for public companies. Obviously, that has just passed. And a year later, or December 15, 2018, for non-public companies. Just as a reference point, outside the US, IFRS 15 is effective for all companies for fiscal years beginning on or after January 1st, 2018. We're excited about today's program and hope that you obtain some meaningful information as you undertake your own initiative to adopt the new revenue recognition standards. Just wanted to take a moment to go over the objectives of what I intend to cover over the next hour or so. First of all, I want to introduce the revenue recognition, the new standard to all of you. And I want to describe exactly how it will impact the specific impacts it will have on technology companies. Ultimately, I want to wrap up by talking about giving you a little bit of perspective and how you can get your own implementation project started. I want to encourage all of you to ask questions as we go through the program. As Amanda mentioned, you can type them in the questions area at the bottom of the navigation box. What I want to do first is to go through the 5 steps in a little bit more detail. Basically, by way of background, the U.S. and the International Accounting Standards Board undertook this initiative to converge the differing revenue recognition standards, U.S. as compared to the rest of the world. In the U.S., for perspective, there were a number of different source documents where you would go if you were looking to determine how best to recognize revenue, and it really was largely industry or type of revenue dependent. This was vastly different than what was being done at an international level, so a project was undertaken to converge the two so that worldwide revenue would be recognized consistently across all companies regardless of what set of accounting standards they used. So what came out of that was a very methodical 5-step approach to recognizing revenue. And I've laid it out here, and we're going to go into it in more detail very shortly. But what I wanted to do is at least lay it out so you understand where each step is going. The first step is to identify the contract with the customer. After that, you identify all the performance obligations in the contract. Ultimately, you determine the transaction price associated with that contract. The fourth step is to allocate the transaction price to each of those performance obligations. And ultimately, you conclude with step 5 by recognizing revenue as the performance obligations are actually completed or delivered. So that's really what we're going to be talking about, and we're going to say a lot of step 1, step 2, step 3, et cetera, et cetera. And that's what we'll be referring to as we go through the rest of the program. So as many of you already know, the new revenue recognition standard is a game changer. It is widely considered the most sweeping, impactful change to the U.S. accounting standards to have ever occurred. There are literally thousands of pages of primary documentation associated with the guidance. Given the density of the material, my objective today is to review key elements of the standard at a high level, just to give you a sense of what's involved. I'm actually going to kick off now with step 1, which is to identify the contracts with the customers. The key to this step is that before any further analysis of recognizing revenue can occur, there must be a valid agreement between a vendor and a customer. The customer must represent an the contract must represent an agreement between two parties that creates enforceable rights and obligations. ASC 606 is not prescriptive in how that agreement between the two parties is established. It can be written, oral, or even implied. What the standard does clearly indicate is that identifying the contract should be based on the seller's ordinary business practices. So in the technology industry, it would not be unfeasible that the contract is electronic in nature. It could even be established by a customer accepting the user terms and conditions. While step 1 on its surface is straightforward, technology companies must consider the entirety of an agreement with its customer, which may include side agreements or contract modifications, which we're going to talk about later. The real crux of step 1, and something that will be relevant as we go through all of the steps, is that you must focus on what you promise and what the customer expects. So for example, if you provide additional services other than what is prescribed in the contract, in essence, if the contract is silent on those services, but the customer expects them, it can be taken as an unwritten promise to provide these services and should be considered in the revenue recognition standards. Let's move on to look at the various elements of a contract. A contractual arrangement with a customer exists only when all of the 5 criteria are met. Firstly, it must be approved by committed parties. Then each party's rights must be identified. Thirdly, payment terms have to be agreed upon. Next, the contract needs to have commercial substance. And finally, collection of any and all payments must be probable. It may go without saying that you must identify all commitments with a customer when evaluating revenue recognition. And therefore, it might be necessary to combine multiple contracts entered into around the same time with a particular customer and treat them as a single contract. The reason for this is to prevent the risk that revenue recognition can be manipulated by breaking up one contract into multiple smaller ones. Additionally, where standardized contracts are used, ASC 606 allows companies to adopt a portfolio approach to adoption, whereby common contracts can be combined and analyzed as a single revenue stream. This is actually good news and may streamline your adoption of the new standard. So moving back to the 5 criteria required to identify a contract, let's discuss in greater detail some of the key takeaways. First, you start in the first stage with approval by the committed parties. It probably goes without saying that it is essential you obtain evidence that a contract exists and the customer has approved the contract. Even more important is that you get evidence that a contract has terminated. This becomes relevant with auto renewal situations. If contract renewal is a reasonable expectation, you must consider the impact on revenue recognition of early termination of one contract with the initiation of a new contract. Depending on the facts and circumstances, revenue recognition may be accelerated or it even could be deferred. Another point to cover is a contract must have commercial substance and collectability is probable. As part of identifying a contract, a key point is to assess whether it's probable you will get paid. If you are unlikely to get paid, then you don't have a contract and therefore cannot recognize revenue. To be clear, this is separate from determining the transaction price, which we will cover in step 3 of this webinar, where we're looking at the creditworthiness of the customer rather than here, where we are considering the customer's willingness to pay. Under US GAAP, the term probable equates to about 75 to 80% likelihood that the customer will pay for the goods delivered or the services performed. Contract modifications are common practice in the software industry. If you are used to dealing with contract modifications, I suggest you review the standard in detail, as your common sense approach may no longer be appropriate. Key points to consider when assessing whether a contract modification has occurred are: have the terms and conditions of the new contract been negotiated separately from the original? Was there a competitive bidding process for the new contract? Do any discounts applied in the new contract actually impact the original contract? Modifications can be applied either prospectively or through a cumulative catch-up adjustment. So it's really important to recognize and think about when your situation changes with your customer, which could happen as a result of customization or an added statement of work that's a bolt-on, things like that. All of those things need to be relooked at specifically as they relate to the original contract. So with that, I would like to move on to step 2, identifying performance obligations. When the entity must identify all the performance obligations with its customer, and then to further determine if those obligations are units of accounting, which has a specific meaning within GAAP. Let's start by establishing what a performance obligation actually is. At the end of the day, it's a promise to deliver a good or service to a customer. That being said, the company has to consider the entire customer relationship in order to properly identify any and all promises within a particular contract. The company must start the process by 1, identifying all the goods and services promised, which again is the performance obligations, and then determining how many of these performance obligations are separate and distinct, which becomes the unit of accounting and drives how the price is allocated. Identifying performance obligations with a customer sounds simple, but many technology companies offer multiple goods and services as part of their arrangements. Take a look at this slide, which shows some of the typical offerings technology companies have. You have licenses, of course, but you also have customer service, implementation, upgrades, just to name a few. Now, again, as I previously pointed out, if goods and services are not specifically documented in the contract, but are nonetheless performed as part of their customary business practices, if the customer has a valid expectation that the vendor will provide a good or service, even if it's not explicitly stated, the entity must consider those as performance obligations. There are 2 criteria that need to be satisfied for a promised good or service to be distinct. As I mentioned before, that's important because those distinct promises create separate units of accounting for the allocation of the transaction price. These 2 criteria are that the customer can benefit from the good or service either on its own or together with other resources the customer has access to, and it must be separately identifiable from the other promises. So in other words, it must have value and must have value on its own. Here's an example of what I mean. Although it's not software related, I still like the example. Take a look at the picture. You see there's a race car and it has a remote control. And they're both sold in the same box. The batteries are required to make the car and the remote operate, and that let's just assume that they're included in the box, batteries included. In this example, how many distinct goods are promised? 1, 2, or 3? Since the batteries can be purchased elsewhere, they should not be considered a separate promise. The customer can get those on their own. But what about the car and the remote? They're also not distinct because the car can't run without the remote. So there is only 1 unit of accounting. There is only 1 unit of accounting in this scenario. one performance obligation. Sorry about that little pop-up. We're not exactly sure what that just was. So let's take a couple of minutes to talk about licensing intellectual property, and because I think it's pretty important. The licensing of intellectual property is an important part of the new revenue recognition standard, not only for software licenses, but for licenses of trademarks, music, franchises, things like that. Specifically, as it relates to technology companies, licensing intellectual property can be a particularly complex area because many software licensing arrangements include licensor obligations beyond just providing access to the software. And there can be multiple payment streams, including upfront payments, payments over time, or a combination of both. The new guidance is going to help sift through the complexity of licensing because there is specific guidance in the new standard relating to the licensing of intellectual property. Without going into too much detail here, most of the licensing guidance revolves around one important concept. You guessed it, identifying separate and distinct performance obligations. All that being said, since there is guidance specific to licensing intellectual property, i.e. software, it's critical that you identify when an arrangement is a service rather than a software licensing arrangement. I am, of course, talking about software as a service, or SaaS, which has become the most common way of selling software. A lot of time, software is sold out of the box, and that's exactly what's going on. Customer receives the software and uses that software and owns it, and that's all there is to it. However, software as a service may in fact be a hosting arrangement, or in other words, a simple subscription service. This will be the case if the customer cannot take possession of the software and the customer does not have the ability to run the software on its own hardware. If that's the case, the section of ASC 606 relating specifically to licensing intellectual property would not apply, and revenue should be recognized as a service is provided, actually really no differently than you would recognize revenue for a magazine subscription. Many companies provide hybrid offerings that represent a combination of on-premises software and SaaS. When a license does not distinguish these components, the company will need to treat the offering as a single performance obligation, similar to the race car and the remote that we talked about a couple of minutes ago. If this is the case, you need to then determine whether the performance obligation is satisfied over time or at a point in time. For example, a software license that solely enables a customer to access content delivered through an online service will probably not be distinct from that online service. So the license would have to be bundled with it. This would lead to recognizing the revenue over the period of time that the customer has access to the data via that online service. In this scenario, the entity ends up recognizing revenue associated with the transaction price ratably over time, which makes sense because the customer did not end up controlling any intellectual property that had value. Now we're going to talk about a few common features with IT license renewals, rights, and cancellations. Software vendors often provide customers the option to renew or extend their term. An option is a separate performance obligation if it provides a material right to the customer that the customer would not be able to receive without entering into the original contract. So what does that mean? It means the right has to be substantially not available to others, like offering a deep discount. One thing to note about renewal options, it actually can cause a delay in revenue recognition as compared to the old rules. Under the new rules, revenue allocated to a renewal option can't be recognized until the option term starts, even if the customer has possession of the software in advance. What about cancellation rights? A cancellation right that allows the customer to cancel a multi-year contract after each year without penalty should be accounted for the same as a one-year contract with a renewal option. So with cancellation rights, you will need to go through the same steps to see if it represents a separate performance obligation. One final note on this, providing additional copies of the software or allowing for additional users generally should be accounted for as additional licenses, and therefore you must look to see if it creates a separate unit of accounting. To circle back to step one, where the standard establishes that you must view the contract from the customer's perspective, we need to think about customers' decisions to annually continue the contract or not. It's from the customer's perspective, which is a different way of thinking about things than the current standard, that the revenue recognition will be derived. And this is where I think companies have to look and spend time to understand the entirety of the customer relationship. Many times our clients think about what is the crux of the contract with their customer and the major parts of the service provided. But the new standard really requires you to look at some of the ancillary things and frankly could result in less of the revenue being recognized up front and more of it being recognized to be in line with those other services that may not be explicitly laid out in the contract. So that's why everyone really has to spend time and understand what they are providing the customer. To wrap up the discussion on step two, post-contract customer support accompanies most software arrangements. PCS is generally a separate unit of accounting from the license, even when PCS is not optional, because the software remains functional without the PCS. The only time it may not be distinct is if the updates are critical to the software utility. So that finishes step two. And now we're on to step three, determining the transaction price. The transaction price can be defined as the amount of consideration a company expects to be entitled to in exchange for transferring promised goods or services to a customer. This would exclude amounts collected on behalf of third parties. Similar to determining what may serve as an appropriate contract with the customer, as discussed in step one, customary business practices would apply to determining the transaction price. What may be obvious is that determining the transaction price is more straightforward when the contract price is fixed, but it can actually get very complex and may require significant judgment when the arrangement includes a variable amount of consideration. I like this chart because it lays out how ASC 606 views the components of a transaction price, and I think it's a fairly good summary of what needs to be considered. So in addition to the fixed and the variable consideration that you see at the far left of the image, the transaction price will also include the effects of time value of money if there is a financing arrangement associated with the purchase, which isn't completely uncommon with large-scale technology projects, as well as any non-cash consideration based on estimated fair value of what is delivered. So you have to add those things to the two defined fixed and variable considerations that might be more explicit in the contract itself. Then amounts that should be deducted to determine the transaction price may include amounts expected to be paid back to customers like credits, vouchers, rebates, or coupons. Again, not completely uncommon in technology companies. And amounts paid to third parties like sales tax collected and remitted to municipalities. All of these components need to be considered before a company can allocate consideration to the performance obligations, which we will get to in step 4. All of these components are important, but due to time constraints, I just want to spend a few minutes focusing on variable consideration. Variable consideration included as part of the transaction price is an estimate that is based upon what is expected. Under the new guidance, variable consideration is calculated as the amount that it is probable of not being reversed in the future, based on future circumstances. Not being reversed in the future is kind of a mouthful, but basically it means what do you expect to get. The amount of variable consideration can be calculated using two different methods. One method is the expected value method, which is basically a probability weighted average exercise based on likelihood of outcomes. And the second method is to identify the single most likely amount to be received within a range of amounts. Either method is acceptable, but the key is once you pick a method for a particular contract, you must stick with that method throughout the term of the contract. So what that means, if you have a long-term contract that might cross over to more than a one-year period, if more information becomes available to you and the likelihood of, and you start with a broad range of possible likelihoods on how much variable consideration you may get, but as time goes by, you get a better sense and it is more likely that there is one particular amount, you can't change the method once you've already started. As you might expect, the variable consideration needs to be updated at the end of each reporting period based on changes in facts and circumstances, although again, you can't change the method. So the amount of the transaction price attributed to variable consideration could in fact change over time. Now we're heading into the home stretch covering step 4, which is allocating the transaction price to the performance obligations. So by now you may see the methodical approach that I was referring to at the outset of this webinar, that the guidance provides for determining the appropriate revenue to recognize in any given period. The objective of step 4 is to allocate the transaction price to each performance obligation in the amount that best represents the amount of consideration the company expects to be entitled to in exchange for transferring the promised goods and services. The first step is to allocate the transaction price to each performance obligation on a relative standalone selling price basis, which is basically the price you would sell the good or service to a customer if it was sold separately. While discounts and variable consideration are typically allocated proportionately among all the performance obligations based on relative standalone selling price, certain conditions may exist which would indicate the discount or variable consideration should be specifically attributable to a single performance obligation. So your starting point to allocate transaction price is the standalone sales price. But what if that is not readily available? In those cases, the standalone selling price should be estimated by taking into consideration all information that is reasonably available, including market conditions or entity-specific factors to the extent that those exist, as well as customer-specific factors to the extent that those exist. To be clear, standalone selling prices are determined at contract inception and are not updated to reflect changes between contract inception and when the performance obligation is completed. Here's a list of a lot of factors that may come into play when estimating standalone selling price when it's not readily available. As you can see, there are a number of conditions which may directly impact technology companies, not least of which is pricing practices used to establish pricing of bundled products. The practice of bundling products and services is quite common in technology companies and is likely an area where these companies will need to spend time when analyzing contracts for revenue recognition purposes. Other conditions of note with respect to technology companies include competitor pricing for similar or identical products and market awareness of and perception of the product. I think so much subjectivity goes into pricing, whether you're first to market or whether you're introducing a product that might disrupt the market, so your pricing practices become very relevant. Also, if you're trying to either break into the market or take over a market leader, which is very common with technology companies, pricing is also impacted in those ways. Finally, the last thing I would point out of this list is the impact of customization that will play a big role in establishing standalone selling price. At the end of the day, there is a lot of information available to you as the provider and also the customer. So there are many factors to consider if standalone selling price of a performance obligation is not readily available. The new standard does not prescribe or prohibit methods of estimating standalone selling price. However, whatever method is used must result in a reasonable representation of standalone selling prices, what you could actually sell it for if you were to sell it alone. Some commonly applied methods that are widely considered as effective are the adjusted market approach, which focuses on customer expectations and may take into consideration competitor pricing and market share. The other, also the expected cost plus margin approach, really relies on management estimates and forecasts and builds in a reasonable margin for the goods or services. So at the end of the day, you can either To determine this price, you can either look at what the customer would expect or what you should be able to expect, building in a reasonable margin based on your company as well as historical performance. There's also the residual approach, which determines estimated standalone selling price by reference to the total transaction price less the total observable standalone selling prices for identified goods and services. So in essence, you're backing into whatever's left over must be attributed to what you can't specifically identify. But this approach can only be adopted if the company sells the same good or service to different customers for a broad range of amounts, or if the company has not yet established a price for that good or service, and the good or service has not previously been sold on a standalone basis. I see that a lot with my clients, my technology clients, where they're really expanding their offerings or going into a different area, and they've never offered this before, and so they don't have, they're responding to a customer need, and so that it becomes kind of the Wild West of determining what to charge for it. So now we're really in the final stretch with step 5, which is all about recognizing revenue when the company satisfies a performance obligation by transferring a promised good or service to the customer. A good or service is considered to be transferred when the customer obtains control. And this is a different concept from before, and we'll get into that. A customer obtains control if it has the ability to direct the use of and obtain substantially all of the remaining benefit from that good or service. Directing the use of an asset refers to a customer's right to deploy that asset, allow another company to deploy it, or in fact restrict another company from using it. As mentioned, a handful of times throughout this discussion on the 5 steps, control should be viewed from the customer's perspective. This concept of control is a significant change from the legacy guidance, which is more focused on the transfer of risks and rewards. The concept of transferring risk and rewards is still relevant in the new standard, which I'm going to show you, but companies will need to factor in additional indicators, which we're going to discuss now. Let's start with determining when a performance obligation is actually satisfied. Performance obligations are satisfied either over time or at a point in time. So what that means is revenue from that particular performance obligation will be recognized in the same manner, either over a period of time or at a point of time. In the absence of being able to recognize revenue over a period of time, which is typically more favorable, the company must recognize revenue at a point in time. While generally, goods are typically transferred at a point in time and services are delivered over a period of time, it's really necessary to analyze the customer contracts to determine the appropriate method. To be assessed as being satisfied over time, the contract must meet the definition of one or more of the following. A customer must simultaneously receive and consume the benefits provided by the company's performance under the contract. So, for example, cleaning services, where every week the cleaning service goes in and cleans the office, and the office or the customer ultimately real-time receives the benefit of those cleaning services. The second way is performance creates or enhances an asset which the customer already controls. So again, a home renovation, you're doing something to your kitchen, and obviously you control the kitchen as well as the house. And finally, an asset is created that has no alternative use to the company, and it has an enforceable right to payment for performance completed to date. This can really be consulting fees. So if you're doing a particular project for a customer and there's no benefit to you as the service provider of any of the research or any of the development that you're doing, you're also afforded the opportunity to recognize that over time. And that third condition was included to take into consideration situations where application of the first two may be challenging. For example, where there is a high customization of products. As mentioned, if the performance obligation is not satisfied over time, then it must be satisfied at a point in time. That point in time is determined when all of the following has occurred. So that means it's the latest of all of these things occurring. And that's why it's typically not as preferential or beneficial as recognizing revenue over a period of time. But those conditions are the company has a right to the payment, the customer has legal title and physical possession of all the goods, the customer has the significant risks and rewards of ownership, which is the only thing that mattered under the legacy standard, and finally, the customer has accepted the asset. The current standard looks exclusively at the transfer of risks and rewards, which is just one of the indicators under the new guidance. This means that revenue may be recognized earlier or later than under the current standard. So there you have it, the 5 steps in recognizing revenue under ASC 606. We covered a lot so far, so I just want to pause to see if there are any questions at this point. And it doesn't look like there are. So, okay, let's continue. Oftentimes, when we discuss the new standards with clients, their primary question is, so what do I need to do? And that's a very fair question. So now that I've walked you through the 5 steps under the new revenue recognition standard, I wanted to take a few minutes to discuss what an adoption policy may look like and what you need to consider. First and foremost, if it's not clear already, the adoption of the new standard is significant, and it should not be a surprise that this undertaking cannot be completed successfully without a notable level of effort on your and other members of your organization's part. This project will take time, so it's critical that you start now. There are not many things about these new revenue recognition standards that you can consistently point to, but one is that adoption of the new standard will be different for every company, not just different for different industries. This will hold true for all technology companies, perhaps more so than companies in other industries. The old adage holds true, the devil is in the details. As an example, I have a tech client that was negotiating a new significant contract. The client asked us to look at this particular contract in the context of the new revenue recognition standard, really just so they could get a better understanding of how the contract will look once the standard is adopted. The Citrin client service team got together to review and discuss the contract as the starting point of the analysis. A disagreement quickly evolved in determining the number of performance obligations that could be identified in the contract, and we were basically split between identifying one single performance obligation or 2. After a fairly lengthy debate, we decided to seek the input of another audit partner, someone who is known within the firm as like a quote-unquote GAAP expert. We gave this individual the contract and agreed to reconvene once he had time to review it. When we re-met, he started by saying, a little snidely I might add, that it seemed fairly clear-cut to him there was only one performance obligation within the contract. As the conversation continued and the facts were further explored, we ultimately all agreed that there were actually 3 separate performance obligations. And that's really a true story. So I tell you this not to cause alarm, but rather to exhibit how important interpreting the details of a contract can be. Rest assured, you will get through this, but it is important for you to prepare yourselves for a 6 to 9 month undertaking that will consume a large number of hours and resources. The folks at Citrin Cooperman are here to help and to serve as a resource as you move forward. As I start to dive a little into the details of what a typical adoption project may look like, I thought it would be important to establish some overall considerations that will apply to any revenue recognition standard adoption project. First of all, recognize that project management best practices must be employed to ensure success. This will include involving the right people within the organization who will likely represent interests and functions beyond simply finance and accounting. A project plan with key milestones and deliverables must be agreed upon at the outset, and a dedicated project manager must be identified to hold people accountable to the established timeline. Additionally, you may find, similar to other technology companies, that your information systems do not readily and easily provide all information to continuously account for new customer contracts under the new standard. As a result, your adoption project may look toward an immediate or a short-term solution to obtain the necessary data to adopt the new standards, with a longer-term or more permanent solution that involves system upgrades and/or modifications. In either case, short-term or long-term, this project will result in a significant amount of change management that will undoubtedly be company-wide, which means you will need to prepare a communication plan that explains what this accounting standard means, why it's important, and expect confusion, perhaps even pushback, from those who are not as in tune with accounting standards in general and what they mean for your company. One further consideration is that it will be important to keep your auditors up to speed on your adoption project, your plan, your process, and any assumptions made and conclusions reached. Ultimately, your auditors cannot implement the standard for you, but they can provide support and concurrence for your assumptions and approach. Finally, be prepared for a high volume of memo drafting. Documentation will be vital to maintaining control and consistency throughout the project. There are three distinct phases to an adoption project: planning, data gathering, assessment, and analysis. As mentioned previously, after the initial year of adoption, there is likely to be an additional phase required to look at longer-term solutions that may involve system upgrades as well as other process improvements. Additionally, the data gathering and analysis phases may be somewhat iterative, as missing information is identified that needs to be obtained in order to complete the analysis. What I'd like to do now is spend a few minutes discussing each phase. The planning phase is really the kickoff of the project. It's here that you will create the project task force, which really should include key stakeholders outside of subject matter experts to the extent needed, as well as management sponsorship. Once a task force is assembled, it's extremely important that all members become conversant with the new revenue recognition standards. This can include not only reading the guidance, but also going through the many examples that are included within the guidance. Having a working knowledge of the standard is so critical in order to eliminate rework and to enable a productive and efficient analysis. Of course, the team does not need to know every detail of the standard at the outset, but must be familiar enough to know directionally where the project is going and what information will be most meaningful as you dive into the details. You should set overall expectations of what adoption of the standards will look like for your organization during this phase. Do you think that the pattern of revenue recognition will notably change? Do you see the projections previously created are out of line with how revenue may be recognized under the new standard? Is it possible that your financial results could drastically change in any given period? It's important to set these expectations so the team is aligned with respect to the overall vision. It is very possible, dare I say maybe even likely, that the end result will differ from the expectations set at the outset. That's part of the analysis. But recognizing the nature of the causes of the differences will affirm that you have developed a good understanding of the standards and how it applies to your situation. Ultimately, the planning phase will result in the creation of a project plan and timeline where tasks are assigned to team members with clear deliverables and milestones. Now we get into the meat and potatoes of the adoption project, which starts with gathering all information needed. What may come as no surprise is that the key data points needed, the driver of the entire project, is all of the contracts your company has with its customers. To get this in a workable format, you first need to identify all the revenue sources within the organization. As mentioned before, in technology companies, this may include licensing, consulting and customization, maintenance contracts, and even hardware, which we didn't really talk about before. Once the sources of revenue are completely identified, you need to look at the actual contracts you have with your customers. While you may start this process of inventorying your contracts at a high level, ultimately, you will need to compile the actual contracts because, as we said at the outset of the program, the devil's in the details. So recognizing the nuances in the actual contract terms will be important as you get to the analysis phase. That being said, you can bundle like contracts where the terms are exactly the same. For example, if you provide a SaaS to your customers who all subscribe to your software by signing an acceptance of use, then you may only have one contract type to analyze. If your sale process includes negotiating terms of the contract to meet the needs of your customers, you may have a large number of contracts to analyze. Data gathering will also include compiling a list of all systems used during the revenue cycle. This may include your accounting system, but also reports out of your database, as well as supporting Excel spreadsheets. Not only should you identify the systems themselves, but you should also delineate what was internally developed and what was acquired from a third party, and what customization was done or is available to be done to those third-party systems. It's important to realize that much of your analysis will be summarized on a matrix that contemplates the 5 steps that we've discussed previously. This phase will include developing the format of such a matrix to ensure consistency of presentation as well as conclusions reached. At the end of the day, the matrix will serve as the backbone to the adoption project, and any contract analysis performed must be captured here. The matrix you use may look different from other organizations, but will ultimately capture contract type, revenue sources, revenue details, systems and reports used to obtain those details, and key process and information owners. Don't be surprised or concerned if you don't have every input for the matrix. There will likely be gaps, which need to be identified with an action plan of how such information will be gathered and by whom. Finally, this phase should identify the impact of any changes to revenue recognition. I've listed some of the items that are most commonly impacted beyond financial reporting: commissions, loan covenants, investor reporting commitments, projections or financial models. The final phase of the initial year of adoption is the analysis of the information in the context of the standard itself. It largely includes evaluating each contract type and responding to the 5 steps that we've talked through. Here you will need to apply a great deal of judgment. Any assumptions should be clearly articulated, not only as a means of supporting the conclusions reached, but also to ensure that consistency is applied across all contracts where applicable. Remember when I said to be prepared to write a lot of memos? I want to circle back to that now. Each contract type needs to be supported with a memo which documents the nature of the contract, goes through the 5 steps, and draws a conclusion as to how revenue should be recognized and the related journal entries to record initial adoption and going forward through the remainder of the contract. These memos, coupled with the completed matrix, will serve as the suite of documentation provided to management and your auditors. The Year 1 project will conclude by updating your internal accounting policies and procedures, revisiting the actual guidance to ensure there were no details were overlooked, and conducting training with key process owners. After breathing a sigh of relief that you have successfully achieved initial adoption of these new revenue recognition standards, you can focus on process improvements that will ensure long-term compliance with the standards is maintained as efficiently and effectively as possible. As mentioned previously, this may include system upgrades and process improvements relating to gathering information and recording transactions on an ongoing basis. To wrap this part of our discussion up, here is a high-level representative project timeline which gives you a sense of how long each phase that we've discussed may take. As you can see, the project can easily take 6 months or more, with the bulk of the effort dedicated toward analyzing the specific customer contracts. With that, this concludes the formal part of our discussion, and I would like to open up the conversation to any questions you may have.
So we do have a quick question from Jay. He would like to know, how will termination for convenience clauses impact revenue recognition under the new rules?
Terminate, it's just again, say termination of what clauses?
Convenience clauses.
Well, termination of convenience clauses is going to have to be considered as, if it has separate value, which it would likely do, it's going to be treated as a separate performance obligation, and revenue will be attributable to that. So it gets broken out separately.
Great. So that's our only question right now. If anybody else has questions, feel free to type them in. We have a little bit of time so we can answer a couple. So we'll give you a couple seconds to type those in. Great. It doesn't look like we have any other questions at the moment, but we will be sending sending a follow-up email to this presentation. So feel free to shoot either me or Mike any questions that you have in the future, and we can address those via email. Any final thoughts before we sign off?
No, I just want to thank everyone for their time, and certainly I encourage you to reach out with any questions. I'm happy to talk about it, and certainly, the specifics of any circumstance are best to be discussed, or exchanged specifically. This was intended to give you an awareness, and I hope that purpose was served. Enjoy the rest of your day.
Great. Thank you so much, Michael. Thanks, everyone.